Esha.
Dr. Daniel.
Wazaza kuvumba se.
Kivumba rwose muyigishwa nande mwebwe.
Menya n'izina rye ntararifata ngo ni gitari.
Ziko twebwe aduhana recordings zose ushaka wazisubiramo kwiga.
Abantu recording. Umva kubwire. Umva wowe. Ndafata nimero yawe uzame kuri recording.
Ufite ahantu yandika.
Wowe umva utihagara ukorera hagana he.
Kigali.
Wigira ko natwe cyangwa
Sara na muzehe twatangiye kwiga.
Bite Deni mukomeze.
Okay, so welcome to today's class. I was just trying to switch off people's video. Last time, 2 weeks ago, there was somebody with all the name who was removing his shirt. I don't know, and his video is on. So I was just told after the class. So kindly let's learn to switch off our videos when we start the class. So maybe to start us off, there is Cat 1 that you are supposed to submit. Kindly, when submitting your Cat 1, don't send it to my official email. You know, we are very many of us, we are around 140. If you send it to my official email, I don't want to have, so maybe you can, I have 2 private emails, but I can give one. I have a Gmail, and I also have a Yahoo. So you can submit your Cats through my Yahoo email address, which I'm just typing in the chat. So please don't use my official email to submit the assignments. So you can see it in the chat. I've just typed it in the chat. Charles Omanyo, my name, just Charles Omanyo @yahoo.com. So that is the email address you can use. Please don't even use the Gmail one. Use only Yahoo so that I avoid having a lot of emails in one. So you can use the Yahoo email address to submit your CAT. Okay, so we have a short time, 1.5 hours to cover income tax. So let's look at this standard called income tax. Every business is obligated to pay tax on their income. Any income that they earn, any business is or person, an individual is obligated to pay tax. Now, income tax is covered in a standard called IAS 12. IAS 12. So in any given standard, there is always the objective of the standard. So what is the objective of IAS 12? The objective of IAS 12 is to prescribe the accounting treatment of income tax, is to prescribe the accounting treatment of income tax, to prescribe the accounting treatment of income tax. So let's continue a step further so that we get room. So there is what we call elements. Of course, you can elements of income what? Tax. What are the elements of income tax? That is what I want us to start with. Elements of income tax. There are two elements of income tax. Some books say there are three, but I will explain why there are three. So we can say there are two elements. There are two elements of income tax. We normally have two elements of income tax. The first element is called current tax. Current tax. Please, this is a very important topic because it's almost there in every exams. So there is what we call current tax, but there is also what we call future tax. So when we talk of elements of tax, they are two. It's either current tax or future tax. So future tax is what is commonly known as deferred tax. So when we look at elements of tax, it can either be current. Current is a tax that is settled in a given period, in a given year. Future tax is tax that is settled in the future. So when we look at the elements, there are two. So some books say there are three elements of tax. In those books that say that there are three elements of tax, they always talk of current tax is split into two. So I'll explain that. So suppose we start with number one. Number one, we start with number one, we have what is called current tax. Current tax as our number one. So when we talk of current tax in this context, it has got two elements in it. Current tax is the tax that is settled in a given period. Tax that is current, tax of a given year. Tax that is settled in a given period. So it is tax settled in a given period or given year. So there are two components of current tax. There are two components, or some books call them what? Elements of current tax. There are two components or elements of current tax. The first component, I'll call it A. There is what we call estimate of the year. And number two, there is what we call over or under provision of the previous year. Or previous period. So when we are analyzing current tax, what the examiner wants you to do is to find out the estimate of the year and over or under provision of the previous year. Now take note, because this will be confusing as we continue. What goes, estimate of the year goes to statement of financial position. Take note of that as we start. Estimate of the year, it's what is taken to statement of financial position, of course, as a current liability. You know, tax is always a current liability. So estimate of the year, because current tax is the tax of the year. So it's a current liability. So estimate of the year is what goes to statement of financial position. Now, to lay some background, because I know there are those who have never covered tax before, I'm laying background for current tax. So background for current tax. So background, some background for current tax. So normally, by the time we are preparing financial statements, assume that we are preparing our financial statement, the year ended 31st December 2020, for example. So if we are preparing financial statements for the period ended 31st December 2020, it means by the time we are preparing financial statements, we still don't know the actual amount of tax that will be paid. So that is my introduction as we start. By the time financial statements are being prepared, we still don't know the actual amount of tax to be paid. Yet you are preparing the income statement. you are preparing the balance sheet. Let's narrow down to the income statement. So if I'm preparing income statement for 31st December 2020 or 2021, whichever year you are preparing, by the time I'm preparing, I don't know the actual amount of tax that will be paid. Because tax, you only know the actual amount of tax to be paid after your financial statements have been authorized for use. That is when you will know that I'm supposed to pay tax of 1 million. Once the financial statements have been authorized for used. How are financial statements authorized? After they have been audited. So remember, audit of financial statements don't take place at the time you are preparing financial statements. They take place after financial statements have been prepared. So if you prepared financial statement for the year ended 31st December 2020, they will not be audited in 31st December 2020. They may be audited sometime in February of the following year. So you will not know the actual amount of tax until your financial statements have been audited and authorized for use. Before they are audited and authorized for use, you are still basing your financial statements on what we call estimates. So that is what maybe if I just use I'm trying to see how to summarize that. So maybe I can say, normally, by the time financial statements are being prepared, we don't know the actual amount of tax to be paid. Take note of that. Normally, by the time financial statements are being prepared, we don't know the actual amount of tax to be paid. Why are we not knowing? Because actual amount of tax is only based on audited and authorized. This is because actual amount of tax to be paid is based on audited and authorized financial, okay, I always like using abbreviation, financial what? Statements. Take note of that. So because it's based on audited financial statements, that is why we don't know the actual amount of tax. Therefore, at the period end, we can only estimate the tax to be paid, but not the actual tax, So that is the introduction that I wanted to bring out. So because by the time you are preparing financial statements, you don't know the actual amount of tax that you will pay, because actual is based on audited and authorized financial statements. So by 31st December, the financial statements have not been audited. Therefore, the tax, once you have got your profit before interest and tax, you less your interest to give you profit before tax. You need to less something to give you, some tax to give you what? Profit after tax. All these is based on estimate. So we will wait until next year, maybe 3 months in next year is when we know the actual amount of tax. So suppose, this is an example. For example, if by the time the financial statements have been authorized, you had estimated tax to be 1 million. And then by the time the financial statements have been audited, you find that the actual amount of tax that RRA is asking you to pay is not 1 million. The actual amount of tax is 1.2 million. That means you had estimated 1 million, but the actual later on turns out to be more than 1 million. For example, 1.2 million. In that case, we can say that you underestimated. You underestimated what? Tax. Why did you underestimate? You said it will be 1 million, but it turns out to be what? 1.2 million. So in that case, you underestimated. So I hope everyone understands what underestimation is. When the actual turns out to be more than what was estimated for the previous period. The opposite of that is overestimation. Maybe we estimated the tax to be 1 million. And then actual amount of tax next year, when RRA is billing you, they tell you that your tax is maybe 900,000. What did you estimate? 1 million. In that case, we will say you overestimated your tax. Remember, we are under the topic called what? Current tax. Don't forget, we've said we have two types of taxes. We have what is called current tax and deferred tax. I'm on number 1, current tax. So we are saying current tax has got two components. There is estimate of the year, and then there is over provision of the previous what? Year, or under provision. So when do we have over provision? So I can now continue with this slide now. Over provision arises, I hope everyone now understands, over provision arises when the actual tax billed, of course by RRA, over provision arises when the actual tax billed is less than the estimate of the previous year. I'm repeating. When do we have over provision? This is important because it affects our balance sheet, it affects our income statement. So over provision, we are saying over provision arises when actual tax billed is less than what? The estimate of the previous year. I hope everyone has understood that. Okay. Sorry. So is less than the estimate. So under provision, take note of this. I hope everyone can even now complete the sentence. Under provision, it arises when actual amount of tax billed is more than the estimate of the previous year. I want that in the next 10 minutes, everybody will be comfortable in calculating current tax, which is the most common part of tax. How will you be comfortable? If you understand these 2 points. Which 2 points? These 2 points, please take note of these. It will cause the difference between understanding tax and not understanding tax. So when do we have over provision? Over provision arises when the actual tax billed is less than the estimate of the previous what? Year. Under provision arises when the actual amount of tax, this actual amount of tax is what? More than the estimate of the year. So that is what you should be looking at. However, I'll give you 2 alternative ways of getting it. Okay, so let's look at finding the current tax. So accounting, let me call it accounting for current tax. current tax. How do you account for current tax? So when you are accounting for your current tax, I'm just trying to see what is in the chat. Okay. Let's stop typing our details. We will type at the end, because when you type, I'm tempted to look at the chat because I think it's a question. So accounting for current tax. So when you want to account for current tax, you always do this. You find out what is the estimate of the year, estimate of the year, you get whatever amount it is. And then you either account for over or under, you account for over or under provision of previous year, of previous period or year. So when you want to know the tax to pay, that is the format to use. You need to find out what is your estimate of the year, which will be very clear in a question. Okay, so estimate of the year, and then estimate of the year of the current year. Current year. So remember, when I talk of estimate of the year, I'm referring to current. Estimate of the current what? Year. Sorry for that. Okay, let me just remove that so that it fits. So estimate of the current year. Now, if you find that we over-provided the tax of the last year, you less it. Please take note of that. If last year we over-provided, you correct that over-provision. For example, if tax for this year is 1 million, last year we find that we had over-provided for tax. Maybe last year we estimated the tax to be 1 million, but the actual amount of tax ended up being 800,000. In that case, we can conclude we over-provided for tax by how much? 200,000. So if there is over-provision, you deduct it from the estimate of the year. So you take estimate of the year less over provision of the previous year. Over what? Provision. So if it's over, it is what? Deducted. If it is under, you add. If we under provided for the previous year, what do? You add. Because we understated, you add. So the answer you get is what we call what? Current tax for the year. So current what? Tax. Or let me just call it income tax. We are assuming there is no deferred tax. Income what? Tax. I've still not covered deferred tax. That gives you income tax. Please take note of this. That is what gives you income tax. I'm just trying to be a bit economical so that everything fits. I hope everyone has understood the introduction. So we have something like that. So I can just say is equals to, so that we have our figures. So this, when we account for that, the answer we get is what gives you income what? Tax. That answer is what gives us income tax. I hope we are together. Now, what I want to add is this. This estimate of the year, because you'll be asked, you'll be preparing income statement and balance sheet. This estimate of the year is what goes to, how can I put it? Goes to statement of financial position. This is what goes to statement of financial position. This amount that accounts for over and under provision is what goes to income statement. So when you are preparing your income statement, please don't put the total. So this is what goes to income statement. So what goes to income statement? Estimate of the year plus under provision or minus over provision. Victoria, slow down, slow down, slow down, slow down. You know, assume that there are people who are meeting this for the first time. Okay, so what we have said, estimate of the year goes to statement of financial position. What goes to the income statement? What goes to the income statement is estimate of the year plus under provision of the previous year or minus over provision of the previous year. I hope we are together there. Let us move a step further. Alternatively, you can use what we call T accounts. T accounts. You can use T accounts. So you can use something that is like that. Alternatively, you can use T accounts. So I'm giving you T accounts so that in exams, you only choose the method that suits you. So don't do both. You can either take estimate of the year plus I'm just trying to set. Just be patient with me a bit. So, alternatively, you can use, just a second, please. Although this one for Musanze students, you already know what I want to do. For Kigali student, we'll be doing cash flows on Saturday. So it will just come out what I want to do. So suppose this is the debit side. This is the debit side of our transaction, and this is the credit side. So if that is the debit side and the other is the credit side, you post what is called balance brought down. Balance carried down is posted this side. Okay, balance brought down. Balance carried down is this side. Balance carried down, you post it that side. Now, how do you know the balance brought down and balance? Opening balance. For example, if I give you taxes for 2 years, tax for the year ended 2019 and tax for the year ended 2020. So estimate of the year ended 2019 will be the opening balance. Estimate for the second year will be the closing balance. So one will be the opening balance, one will be the closing balance. And then you find what was the cash paid. How much did you actually pay RRA? You post your cash paid. Now, of course, you know you get the totals on each side. The totals on each side. The total on the debit side, which will automatically be more than the total on the credit side. Now, if you get the cash paid during the year, cash paid in the year, in the period, closing balance, opening balance. If you compare the two, this side should be more than that side. This total of the debit side is the same amount you bring here. So which means if you get the difference between this total and that, the balancing figure, the balancing figure is what goes to what? Income statement. So let me just write IS instead of writing in full. Income statement. Remember, it's a balancing what? Figure. You know what I mean by balancing figure? This plus that minus that is what gives you balancing figure. Now, this balancing figure is calculated. It's not given. It is what? Calculated. I've put it in red so that you can know it's calculated. Now, please understand me. This balancing figure is calculated. This is what goes to the income statement. Now, this closing balance is what goes to statement of financial position. So I hope, Victoria, I've answered your question, but I was coming to it. You are going ahead of the subject. So you have two ways of calculating. Two ways. What are the two ways? The first way is just to find out what is the estimate of the year. You put it there. And then you find out in the previous year, was there an over or under? Now you see this figure here, this one here is the same as what you get here. So if you use T account, this is called a T account. If you use T account, this balancing figure is the same as this answer here. If you are right in accounting for over and under. I hope we are together. So you have alternative ways. So this is the method one of how to find it, and the other one is method two. I'll do the same. So let's look at an example. Okay, I'm being asked to name the account. Name the account is income tax. Income tax. I was just trying to do some editing. I was trying, of course, to merge the cells. And I'm trying to just, let me try to. I know I should be naming. I'm just trying to. Oh. I was just trying to merge. Okay, it has come. So I was just trying to merge. It has managed to merge. So it is called what? Income tax account. Income tax account. So that is the name of the account. I've named it. Okay, but naming of the account is more of financial accounting than financial reporting. Okay, why don't we go to examples? Now, Victoria, I'll not answer your question for now. We have not even attempted any question, and you are already asking another question. So please hold your question until we complete even deferred tax, and then you can ask your question. I thought that this is what you are asking. Hold your question, please. Hold your question. Be patient, yeah? So let's continue. So let's look at an example. I have 3 examples that I want us to cover. Three very short examples. I have quite. So let's quickly look through these. But Victoria, really, that is more of financial accounting than financial reporting. You know that if an item is on the debit side, you should know whether it's an income or it is an expense. If it is on the credit side, you should know whether it's an income or an expense. If you can answer that question right, it will even answer your question before I comment on it. But that I can cover once I finish. So let's carefully follow this question. The estimate of the year ended, that is estimate of tax, of course. The estimate of the year ended 2006 was 200,000. The estimate of the year ended 2007 was 250. So this is the first year, this is the second year. Actual tax for last year being 2006, was what? This is now actual tax that was paid, is 235, which was paid in 2007. Now you are being asked, show the extract of the income statement and statement of financial position for the year ended 2006 and 2007. For the year ended 2006 and 2007. So in this question, we have said, if I start with the year, you have been asked for 2 years, 2006 and 2007. So suppose I start with 2006. So let me start with 2006. Year 2006. Year 2006. So in year 2006, I'll start with what is the estimate of the year. What is the estimate of the year? In 2006, what is the estimate of the year? The tax estimate for the year ending 2006 was 200,000. So, just a second. So, estimate of the year you can all see it is 200,000. I hope we are together. So I've put it in the wrong place. Estimate of the year is 2,000. Now, in 2006, we have not been given any figure for 2005. There is no figure for 2005. So I can say under stroke what? Over provision of previous year is equals to 0. Previous year being what? Previous year being 2005. We were not given. So that is being 2005. We were not given that. Sorry for my typos. 2005 is 0. So what will be the income tax for the year? Income tax for the year will be equals to 200,000, of course, plus 0. What do we get? 200,000. That is for which year? 2006. That is for the year 2006. Okay, now this is what I was saying. If you are preparing financial statements of the year 2006, this estimate of the year is what goes to statement of financial position. This is what goes to income statement. You are asked for 2 years. So this is what will go to the statement of financial position as a current liability. As a current liability. This is, of course, what goes to the income statement. You subtract it from there. You get profit before tax, and then you less what? This amount. You less this amount as an expense. So profit before tax, you less the income tax. Okay, Keza, I've understood you. Thank you. I've understood you. You know, sometimes what I type is not what I mean. We were in the year 2000. That is why we need to be keen sometimes. We were in the year 2006. So previous year is 2005. I hope I've corrected that. So next we are going to year 2007. Because you are asked, show the extract of income statement. So this is what goes to the income statement. This is what goes to the income statement. This is what goes to statement of financial position. So let's go to the year 2007. I'll again take the figures the way they are so that I save time. I'll copy. I'll come and paste. Maybe I paste using that. So let me remove this. Now, what is the estimate of the year 2007? The estimate of the year 2007 was 250. So estimate was 250. Estimate was 250. And now, here is where the point is. Now, the previous year is 2006 now. If we are in 2007, the previous year is 2006. Now let's read. Estimate of the year was 250. Let us be careful. Actual tax for last year was how much? 235 for last year. We are in 2007. Last year, actual tax, which was paid in 2007. So the tax for last year, 2006, was actually 235. But it was paid in which year? 2007. Now, what did we estimate last year? We estimated last year the tax to be 200,000. And then it turned out to be what? To be 235. So we can say that we estimated 200, but the actual was 235. So we can conclude that we underprovided. Why did we underprovide? We provided for 200, but the actual was 235. So we underprovided for last year by how much? 35,000. I hope everyone is seeing 35,000. How do you get 35,000? 35,000 is equals to 235 minus 200,000. So it is how much? 35. So we said if you underprovided, what did we say? If you underprovided, you do what? You add. If you overprovided, you less. If you underprovided, you add. So what will be our answer? Our answer will be equals to 250,000 plus 35 if it is under provision. So this 250 is what goes to statement of financial position in the year 2007. This is what goes to income statement in the year 2007. In the year 2007. Now explain why you compare the data for different years. You know, data you are given is for different years. You are given tax for this year and also tax of the last year. My opening statement, when I was giving background, I said, by the end of the year, we always don't know the actual amount of tax to be paid. By the time you are preparing financial statements, you don't know the actual amount of tax to be paid. You don't know the actual amount of tax to be paid by the time you are preparing financial statements. That is what I started with. Now, next year, maybe 3 months after the year end, is when RRA will bill you after seeing your audited accounts. That means tax of this year is also related to next year, because next year is when you will know the actual amount of tax. So if you are preparing financial statements of the year 2007, you will also need to know what took place in the previous year, so that you need to know whether it was now under provision or over provision. So that is why it's very important to know what were you given in the question. Now, all your questions don't ask you for current year. For the year 2006 or its equivalent, you will see a past paper question. It asks you for 2007, because in 2007 is when you can know what happened last year. So in all your questions, it will take the scenario of 2007. Now, let me take you back to financial accounting a bit. So when I take you to financial accounting, see what I'm doing in financial accounting. I'm just taking you slightly in financial accounting, and then we'll come back to financial reporting in a short while. So in a financial accounting, there is T accounts that we normally prepare. So if suppose this is our income tax in which year? Income tax in the year, income tax account in the year 2007. in the year 2007. Please understand me, everybody here clearly. So credit. So in financial accounting, we have said opening balance. Balance brought what? Down is posted there. Balance carried down. Carried down. I believe many people will apply this. Now, opening balance, take this to be opening balance, this to be closing balance. This is now financial accounting. It helps us to explain it better. So the tax estimate for the year ending 2006, for the year ending 2007. So we have two figures. So 200 and 250. 2006 is 200. So closing balance in 2006 is opening balance in 2007. So this will be 200,000. Closing balance in 2006 will be the opening balance in 2007. So the estimate of the year 2007 is that. So this is opening, this is closing. So we are in 2007. Actual tax for last year was 235,000, which was paid in 2007. So cash paid in 2007. What is the cash paid? Cash paid in 2007 is 235,000. Cash paid in 2007. I hope you have seen that, which was paid in 2007. Now, what I was saying was this. You compare the debit side to the credit side. Which side is more? The debit side is more. So you get the total, 235 plus 250. What does that give you? 485. The amount that is more is what you post on both sides. The amount that is more is what you post on both sides. So that is our T account. Now, what we were saying, this is 485, this is 485. This one is not complete. There is a balancing figure here of 485 minus 200. How much is that? 285. This is what goes to the income statement. And what goes to the income statement is the balancing figure. Now, this, of course, is what goes to the income statement. This balance carried down is what goes to statement of financial position. Statement of financial position. Now, my question is, between these two methods, which one is easier? Between that and that, apply the one that is easier. Don't use the two. You will be wasting time in exams. Remember, this is a balancing figure. Which one is easier? Maybe you can just type in the chat so that I see. So that is the second one. Use of the account is easier. So use in exams, use the one that is easier for you. But when I'm teaching, I'll be using both. Thank you. I've at least understood you. So this is what goes to the statement of financial position, the closing balance. This is what goes to, you see, 285, 285. So instead of reasoning whether it is under or over, sometimes it's confusing. Just use the T account and you'll easily understand which one. Now, instead of, okay, yeah, thank you, I've understood you. Okay, now if you didn't like T accounts, you must like them now. Because this week, even weekend, will just be in T accounts in cash flows. So you must learn to like them. You don't have a shortcut. Can we go to another question? I'm skipping this example. Should I skip it? Let me just take 2 minutes on it instead of skipping it. The estimate of the year ended 2006 was 200,000 and the estimate for the year ended 2000. Okay, so let me just, it's important to also do this. Solution. It is important because of some point. Example 2. So solution for example 2. So just be patient with me. It is something different, so that's why I'm doing it. It gives you a different scenario. So let me just copy this so that I save time. I'll copy that. I'll come and paste it there. Okay, so be with me in this example too. So if you didn't understand example 1, please understand this example 2. And then we go to a past paper question. So estimate for the year ending 2006 was 200,000, and estimate for the year ending 2007 was 250,000. Actual tax for last year, which was paid in 2007, was 180. So if I'm preparing 2006 accounts, estimate of the year 2006 is 200,000. I hope everyone is seeing that 200,000. Now let's look at there is nothing. There is nothing for 2005. Your questions will always be 2007. I will explain what I mean by that. So this will be that, of course, plus 0, which gives you 200. But now I'm interested in 2007. What is the estimate for the year 2007? And the estimate for the year ending 2007 was 250,000. Please, let's be attentive here. Now, the actual tax for last year, 2006, which was paid in 2007, was 180. So the actual tax paid was 180. Last year, what did we estimate? 200. We ended up paying less. So we over-provided. Because we estimated 200 and we ended up paying what? 180. So I can say, if it is over provision, what did we say? You less. So if it is over provision, you less. Sorry, you less. If it is over provision, it is over. So that is why I looked at example 2, because I knew it will be over. So if it is over provision, you less. How do you get the over provision? It is 200,000 minus 180,000. What does it give you? 20. So if it is over provision, it is 250 minus 20. What does it give you? 230. So we have said this is what goes to statement of financial position, and that is what goes to the income statement. What goes to the statement of financial position? I've also given you what goes to the... Okay. Now, you told me, you are the ones who told me that T account is easier. So let's post T account. We see if we get the same answer. So, okay. We want to see if we get the same answer. Okay. Or I'll copy that and come and just paste it there. Okay, so I've pasted that there, but I'll remove these figures so that we reason without seeing them. Okay, so let's look at this. In the year 2007, what was the balance brought down? Opening balance. Estimate for the year ending 2006 was 200. And estimate for the year ending 2007 was 250. So opening is 200. Closing is 250. Closing is 250. Now, what was the cash paid? The cash paid was actual tax for the year, which was paid was 180,000. Cash paid was 180,000. So cash paid was 180,000. Cash paid was 180. Now, the total, of course, this is more. That plus that, what does it give you? 430. So your total is 430. What will be your balancing figure? Your balancing figure will be equal to 430 minus 200. What do you get? 230. This 230 is the same as that. So this 230 is the same as that. Again, you choose the one that you easily remember. The one that you easily remember. So I've given you two options. Let us look at a past paper question. December 2018, question 4, part 4. December 2018. Question 4. So December 2018, you can note it somewhere. December 2018, question 4, part 4. So let's read this. It is always questions on standards. These are standards, which means each question was 5 marks. These are questions purely on standards. It means each question was how many marks? 5 marks here. So let's read at the question. Advise the management of GEL on the treatment of transaction 1 to 4 above. But I'm interested in transaction 4 and above and its financial statements, giving financial statements extracts where applicable for each given transaction. So let's start from the beginning. It's a long question. So let us be patient, please, as we read the question. Gisenyi Enterprises Limited deals in marketing agricultural produce. The company has registered tremendous growth over the years since its inception. The growth has been due to increased demand for agricultural produce that is used for domestic and industrial consumption. During the year, please note the year. During the year ended 30th September 2018. During the year ended 30th September 2018. So take note of that. 30th September 2018. Take note of that. During the year ended that, of course, I'll remove that. So when did this year start? A year that ends in September, it's in 2018. That means it started on 1st October of the previous year. So it started on 1st October 2017. I hope we are together. So let's carefully read. Produce bought at 65.5 million during the year was in stock on 30th September 2018. Due to changes on demand pattern, the management planned to sell this inventory and the selling price for the produce in the available market was 70 million. GEL would incur commission of 4 million and transport costs of 2 million to sell this produce and still pay monthly rent of 3 million. Management is not sure of how this inventory, this is IS2. I'm not on IS2. So statement 1 is on IS2. So statement 1 is on IS2. We are interested in statement 4, remember that. I'm just identifying the standard. On 1st October, this is the beginning of the year, G acquired a loan from International Development Bank of USD 70,000 to boost its expansion. This loan was to be repaid within 5 years with yearly equal installments. By 30th September, that is end of the year, no installment had been paid. It was also established that a motor vehicle worth 30,000 was bought on credit on that, and the payment was made. This is IFRS 9 and IFRS 7. Financial instruments, but there is also borrowing cost in it, IAS 23. I'm sorry. I'm sorry for that technicality. My screen went off. Sorry. So that is IFRS 9 and also IAS 23. Let us continue. GIL compensates customers who are sold goods and later are found to be defective or not meeting the specifications made by the customer. During the year ended, I don't expect you to ask a question in a standard that we have covered before or in a standard that we are yet. I'm looking for the question on income tax. So please raise your hand when you reach income tax, please. During the year ended 30th September 2018, Gikondo Limited, a major client of GEL, bought produce from the company, but later realized that it did not meet the specifications given and sued GAL for damages. The lawyer of GAL have advised its management to settle the case out of court as chances of losing the case are high. This is IAS 37. IAS 37. What is IAS 37? Provisions, contingent assets, and contingent liabilities. We will look at it. That is IAS 37. Now remember, as we go to the fourth part, the fourth part now is where we are. The year begins 1st October 2017 and the year ends 31st September or 30th September 2018. So let's read. During the year ended 30th September 2017, the income tax on the profit had been estimated at 25 million. And during the year ended 30th September 2018, GEL had taxable profits of 91 million. GEL had taxable profit of 91 million. The directors want to know what tax is payable as at 30th September 2018 due to the fact that tax due on profits for the year ending September 2017 was later established and agreed with Rwanda Income Authority at, it's supposed to be Revenue Authority, at 31 million. The corporate tax is 30%. So the corporate tax is 30%. Now, as I go to Excel, take note of the dates as I open the same question in Excel. So December, so it is this same question. Now. I don't know which method to use. Okay, let me just use all. Solution. Please understand me. Before I start solving, remember the year ends what? The year ends 30th September 2018. That is the year ends. Year ends. So that is year ends 30th September 2018. So when does that year begin? Begins what? It begins 1st October 2017. It is very important to know the dates. So what is estimate of the year 2017? Estimate of the year 2017 we have been given. So what were we given as estimate of the year 2017? Okay, just a second, please. So what were we given as estimate of the year? When I talk of year ended 2017, is the year ended 30th September 2017. During the year ended 30th September 2017, the income tax on the profits had been estimated at 25 million. So note that this is 25 million. So I'm writing it in full. So it was estimated at 25 million. Here is where many people could have gone wrong. Now next, 25, and during the year 30th September 2018, during the year 30th September 2018, GL had a taxable, so 2018 profit, taxable profit. This is not tax, this is profit to be taxed in 2018 is equals to, please understand me, the taxable profit in the year 2018 is equals to how much? 91 million. 91 million. Now, estimate of, this was a 5 marks question, of tax in 2018 was not given. So how do you calculate it? You are told here the corporate tax rate is 30%. So it will be 30% times 91 million. So what do we get? 30% times, of course, 91 million. So 30% times 91 million. So what is the estimate of the year? It is that. Now next, actual tax paid. Actual tax paid for 2017 in 2018. I'm repeating. The actual tax paid for the year 2017, but it was paid in which year? 2018. Was later established and agreed with Rwandan Revenue Authority at 31 million. So that is the tax actually. Now with this, so we can look at the year 2018. So year 2018, let me say here ended 2018. You'll have to find what is the estimate of the year. Estimate of the year is equals to which year? 2018. Estimate of the year 2018 is this. I hope we are together. Estimate of which year? 2018. And then we check 2017. In 2017, we had estimated 25, but we ended up paying 31. Can you type for me in the chat? Did we overestimate or underestimate? We estimated 25. We ended up paying 31. Just type in the chat, please. Did we overestimate or underestimate? We underestimated. Thank you. So what did we say? If it is under, that is enough. If it is under, what do? You add under provision of previous year. Previous year. Under provision of previous year. So what is the under provision of previous year? It is 31 minus 25. So what does it give you? 6 million. So if it is under, you add. You take 27 plus what? 6. What does it give you? 33. So what will this be? What do we call this? This will be the income tax. Income tax for the year. And what have we said? This figure goes to statement of financial position, and this figure goes to the income statement. Let me write in capital letters. This goes to statement of financial position, and the other one goes to the income statement. Now, this is method 1. To those who want us also to use method 2, let me pick this to save time. So, to those who want us to use method 2, we can also use method 2 here. So that in exams, you only choose one that suits you. So method 2 is there. So method 2, you see I've just copied the format just to save time. So of course, figures are different. Don't confuse the figures. Let me remove them. Don't confuse the figures, please. Let me remove the figures so that you don't confuse. So what is we are now in which year? 2018. 2018. So let's look at this. What is the opening balance in 2018? Opening balance in 2018 is equals to the closing balance in 2017. Closing balance in 2018 is that. I hope we are together. The tax that is paid, actual tax paid is how much? Actual tax paid is 31. Actual tax paid in 2018 is 31. So what do? We have said you take 31 plus 27. It gives you 58. This 58 is what comes the other side. And then you get the balancing what? Figure. What is the balancing figure? 58 minus 25. What does it give you? 33. Is it the same as this? Yes, it is the same. So whichever method you choose in exams, you should know how to calculate based on that. You should know how to calculate based on that. Now, is there a question up to that point? Let me look at the chart and then we move on. Draw extract. Now, extract, you know, this was an item with other additional. So extract is just extract of income statement for the year ended 30th September 2018. And there are expenses in the income statement. So you just write income tax. How much is it? Which is an expense. You take this amount of income statement. That is extract of income statement. To the person who has asked the question, I thought that it is understandable, but because you have asked, that is what is called extract. Now, and it is what? It goes under expenses. And which expenses? Profit before tax, and then you less the tax as an expense. Extract of what? Extract of statement of financial position as at 30th September 2018. What will it be? It will be current what? Liabilities. Current liabilities, and there will be what we call income tax, of course, payable. Income tax payable. So what is the income tax payable? You take the amount that goes to the balance sheet. That is what we mean by that. Is it clear to the person who asked? You can just type yes so that we move on. That is extract. That is extract of statement of financial position. Now, each additional information will give you what goes to the extract. Each additional information gives you what goes to the extract. Okay. Now, for example, if there is a question on government grants, maybe additional information one is on government grants. You should know in government grants what goes as income. So there will be an income government grants, and then expenses income taxes. Government grants, there will be non-current liabilities, but there will also be current liabilities for government grants. Maybe there is another one on leases. Leases, again, you should know there will be extract of income statement, there will be depreciation, and there will be finance charge if it was a question on leases. Extract of statement of financial position, there will be non-current assets, there will be non-current liabilities, and there will be current liabilities, so that the extract is complete. Can you allow me to move on? The most important part we have not even started. Yes, thank you. Income statement extract is profit before tax minus income tax. Yes, then you get what? Profit after tax. Thank you. You've understood it? So let's move on. I'm seeing a long chat here. Thanks, lecturer. You are saying that we can choose the method we want? Yes. If we choose method one and the examiner asks you to show the under or over provision amount, no. The examiner will ask you for the extract. However, if the examiner asks you for over or under, which is rarely asked, the examiner will ask you for the extract. If they ask you for over or under, you must use method one, because method one is what gives you the over or under. And now, if it is in a trial balance, the over or under is normally provided in the trial balance. If it is in a trial balance, but I will come to that. Over or under, how do you know that it was over provided? If it was over provided, in that case, if it was over provided, the amount will be on the debit side of the trial balance. But I will come to that when covering published accounts. If it is on the credit side, it will be under provided. But again, that I will cover when covering published accounts, when we are preparing full income statement and full balance sheet. I always share, please, I'm a Felician, if I pronounce it right. I always share the workings. Talk to your friends, talk to your friends. They have the workings. They have the workings. So can we move on, please? We are remaining with 30 minutes. So 30 minutes, allow me to move on. We are remaining with 30 minutes. So I hope you've understood that. Now let's go back here. We said that elements of income tax are two. There is current tax, which we can now conclude there is in the current tax, you can conclude there is the estimate of year plus what? Plus over or, okay, so let me just talk, and what? Over stroke what? Under provision. So that is what we have under current tax. Under current tax, you should know how to account for estimate of the year, what goes to the balance sheet, and how to account for over and under, which we have looked at. Let us go to future tax. Future tax is also called deferred tax. So let us go to future tax. Future tax. So number 2. So we are finished with number 1. So number 2, we are looking at now deferred tax. Now here is where we always have a lot of questions. I expect questions even before we start. So deferred tax. So deferred tax, as I start, it is also known as what? Future tax. Deferred tax is also known as future tax. Deferred tax is also known as future tax. That is the future tax that is either payable or deductible. Future tax that is either payable or deductible. Okay, that is either payable or deductible. So future tax that is either payable or deductible. So let's continue. Now, there are some small things. The deferred tax normally arises when there is a difference between accounting profit and taxable profit. I know there are questions there. So when there is a difference between what? Accounting profit or taxable profit. When there is a difference between accounting profit or taxable profit. Now, the profit that the taxman RRA taxes is different from accounting profit that we calculate. There is what causes the difference, causes of the difference between accounting profit and taxable profit. There are causes of those differences, but as we continue, I'll be mentioning those differences. Okay, please let's avoid typing your details right now. You are making me to go to charts to read, yet it's not. So I'm coming back. What causes the difference? If you have been asked, what causes deferred tax? Differences between accounting profits and taxable profits. I'll come back to that. Don't worry about that. Let me define some terms. Definition of what? Terms in deferred tax. Some terms that we'll be using as we continue with deferred tax. Definition of terms in deferred tax. So there are very many terms that I want us to define. Maybe the first term that we can define, let me reduce the size so that I'll be in a position to do many definitions. The first definition that I want us to define is what we call a tax base. tax base. Tax base. We will commonly be using this word, tax base. What is tax base? This is cost of the asset, cost of the asset less capital allowance. Less capital allowance. So if you've been asked what is a tax base, tax base is cost of the asset, you less the capital allowance. Capital allowance, for example, if you buy, let me give you an example of capital allowance. If you buy a non-current asset, when the government compensates you for buying that non-current assets, it reduces the amount of tax that you are to pay. For example, if the asset is worth 1 million and the government gives you an allowance of maybe 25%. So which means on 25% of 1 million, you will not pay tax on that. So if the cost of the asset was 1 million and you have been told the capital allowance is maybe 25%, you calculate 25% of 1 million and you will not pay tax on 250,000. So that is an allowance that the government gives you. It is like a, how do we call it? I'm trying to look for it's a tax relief. A tax relief of 250,000. If I use taxation knowledge, although we are in financial reporting, I'm avoiding words in taxation. So it is a relief that has been given in form of what we call capital allowance. So on every non-current asset that you buy, sometimes you are given a relief if it is the practice of the country, if it is a policy of the country. The second definition that I want us to learn, which you all know, is what we call carrying amount. The good students that we are, you know what carrying amount is. Carrying amount is what? Cost of the asset. Cost of asset. You less what? Less accumulated depreciation. Less accumulated depreciation. Accumulated depreciation. Okay, I hope we are together there. So the second definition that we have learned is what is called carrying amount. It is also important. It will affect our deferred tax. Now, the third definition that I want us to define, which is very common in exams, is what we call deferred tax asset. Tax asset. Deferred tax asset. Deferred tax asset. Deferred tax asset arises when the tax base is greater than the carrying amount. Take note of that amount. That is why I was defining tax base and carrying amount. So deferred tax asset, it arises when the tax base is greater than the carrying amount. What is tax base? It is cost of the asset minus capital allowance. The exam question will be very clear on what the allowance is. Now, of course, if it is deferred tax asset, it will be treated as a non-current asset because it's an asset. I'll come back to that when showing extracts. Number 4, deferred tax liability. Deferred tax liability. Deferred tax liability arises when, you all know this, when carrying amount, and you know how to calculate carrying amount, is greater than tax base. Please take your time to reread that. Take your time. It is extremely important. Take your time to understand that. So when do we have deferred tax asset? Deferred tax asset is when the tax base, is greater than what? Is greater than the carrying amount. When the tax base is greater than the carrying amount. When do we have a deferred tax liability? when the carrying amount is greater than the tax base. What is tax base? Tax base is cost of the asset less capital allowance. What is carrying amount? Cost of the asset less accumulated depreciation. Okay. Now, what causes deferred tax? What gives rise to deferred tax? So that is after definition. What causes this calculation of deferred tax? We can say deferred tax is caused by the difference between what? What did we say? Is caused by the difference between accounting profit and taxable profit. I've already said that. I'm just repeating that. Is caused by the difference between accounting profit and taxable profit. Take note of that. Now, in accounting profit deducts depreciation as an expense. So in accounting profit, when you are finding accounting profit normally deducts what? Depreciation. Accounting profit normally deducts depreciation as an expense. Taxable profit deducts capital allowance as an expense. So this is basically the difference between accounting profit and taxable profit. So which means when the taxman, when RRA wants to know the tax you are to pay, they don't recognize depreciation. What do they recognize? They only recognize capital allowance. They don't recognize depreciation. Yet in your business, when you are calculating your profit, you normally deduct depreciation as an expense. While when RRA is calculating their profit, the profit that you have made, they don't account for depreciation. What do they account for? They account for what is called capital allowance. Therefore, taxable profit is equals to accounting profit plus depreciation minus capital allowance. Please take note of this. In other words, when RRA is calculating your tax, what do? They don't recognize depreciation as an expense. So what they do, they take your accounting profit and they remove this depreciation that you are deducted to reduce your profits. So how do they remove it? By adding it back. And then they deduct capital allowance. That is what gives you taxable profit. And then this amount is what now RRA taxes. The answer you get is what RRA what? Taxes. So when you have been given accounting profit in the income statement and you want to know the actual amount of tax to pay, you take the accounting profit, you add back depreciation. Why do we add back depreciation? Because RRA does not recognize what? Depreciation as an expense. RRA recognizes what is called capital allowance. So you add back this depreciation and then you deduct what? You deduct capital allowance. Okay, I'm seeing some points. I'm remaining with 15 minutes. Define capital allowance to, please come back on capital allowance and tax base. Dear lecturer, how carrying amount can be greater than tax? How can carrying amount be greater than tax base? You know, that is a good question. That means we are together. I'll be answering as Now, capital allowance is the relief that is given. Please understand, it is the relief that is given. Maybe I define it here. I can define it as number 3. So somebody has asked me to define capital allowance. Capital allowance. Capital allowance is the relief given on cost of the asset. What do you mean by that? When you buy an asset, you've spent an amount, the government may give you a tax relief. So it is a tax relief. Tax relief given on the cost of the asset. Tax relief given on the cost of the asset. Tax relief given on the cost of the asset. Again, here, I'm repeating, I have a problem with those who are exempted F2.4. F2.4 is taxation. Those who are exempted, I know you will struggle here a bit. So it's the tax relief given on the cost of the asset. Can we move a step further? Please, I'm not picking hands. I'm only reading through the charts. Sorry. When there are gain or loss on, please, Alexis, don't go ahead. When there is a gain or loss, we have not finished the standard, please. Why accountants of a company don't use the same way of the RRA before? Why are accountants? You know, accountants don't know the tax capital allowance rate. So when accountants, they're preparing their income statement, they prepare their income statement based on what we call accounting profit. They account for the real expenses incurred in the business, like depreciation, rent, etc. Accountants don't account for the reliefs. They don't account for the reliefs that are given by RRA when preparing the income. That is why when preparing the income statement, you will not see an item called relief, tax relief. No, you will not see it, because that is now the duty of RRA. When we are preparing our income statement, IAS 1 does not allow us to account for what? Reliefs. Reliefs are only accounted for when calculating taxable what? Profit. That is why reliefs, you only meet them in taxation F2.4. You don't meet them in FR. You only meet them in FR under the standard IAS 12. Under the standard IAS 12. Allow me to move so that I'm in a position to wind up. Now, how do you calculate the deferred tax? So accounting for deferred tax. This is where I want to stop so that okay, I'll use strictly 10 minutes. Accounting for deferred tax. How do we account for deferred tax? Deferred tax is normally accounted for by what we call liability method. Deferred tax, I'll call DT. When I talk of DT, moving forward, just know it's deferred tax, is accounted for by use of liability method. Liability method, previously, it was called so you'll find some books which are still calling it like this. Previously known as, so if you find a book using this, you know it's an old book. Previously known as balance sheet approach. Previously known as balance sheet approach. So using a method called liability method, which was previously known as balance sheet approach. There are some people who still use a method called income statement method. So there is another method, but I don't want to use it because IAS 12 discourages you. So what is the format? Format for calculating deferred what? Deferred tax. Please let's understand this format as we wind up. Format for calculating deferred tax. How do you calculate deferred tax? So in calculating, I'll have these. So I'll have something like this. Again, I request you be patient with me so that it comes out well. Okay. When you want to calculate deferred tax and maybe it's a 5 marks question, always just follow this format and you'll be right. You show your period, the years, you'll be given a number of years. You show what is called carrying amount. Let me write in full. Carrying amount. Everyone knows what carrying amount is now. You show the tax base when you are calculating. You show the difference between carrying amount and tax base. So here is difference between carrying amount and tax base. Difference between carrying amount and tax base. You show the difference. Next, difference, and then you'll have what? Deferred tax. This is what give you deferred tax. Okay, I didn't need the last column. So that is what you'll just be showing when you are calculating that. Now in periods, when you are showing your years, the year of acquisition of asset is called year 1, year 0. Year 1 is the first year of use of the asset. Year 2, the second year. Year 3, etc. All the years. Remember, carrying amount is equals to, what is carrying amount? We have said it's cost minus accumulated depreciation. Cost minus accumulated depreciation. Cost minus accumulated depreciation. That is carrying amount. What is tax base? Tax base is equals to cost minus capital allowance. Cost minus capital allowance. So of course, this is the difference between deferred tax is equals to the difference times the tax rate. The difference times the tax rate. The difference times the tax rate. So that is how you get the deferred tax. Please, if you use this format, you will always earn majority of the marks. Now, can you just allow me to maximize my time in the seven minutes that are remaining? At least I do something in 7 minutes and then we stop there. I just apply these. I apply these in the next 7 minutes and then we will stop. Take note of this question. It will help us introduce as I apply. You can read it, please. Read this. Normally, these standards, I pick them from IASB portal, International Accounting Standards Board portal, which gives you everything on the standards. So know that this is the actual practical, what the standards recommend. And that is where I also pick the questions from. I hope you have read the question. The question reads, the following information relates to X Limited. Cost of the asset is 40,000. Depreciation is 20% on cost. Residual value is nil. Capital allowance. In the first year, the capital allowance is 50%. In the second year, the capital allowance is, between the second and fifth year, the capital allowance is 12.5%. The question is from your notes. The question is from your notes. The question is in your notes. You'll find it in your notes. Just go to the standardized 12 and you'll get the notes. Okay? So you have been given these. Now, I'll have some workings. And working one, please, when questions are more, we will go past 8. Thank you for telling him that. Page 56. Somebody says it's page 56. So working one, in our working one, I'll look at depreciation. Depreciation per year. So what is our depreciation per year? Is equals to, the depreciation was 20%, of course, times the cost of the asset. The cost of the asset is 40,000. You can see that, 40,000. So what does that give you? It gives you 20% times what? 40,000. So what do we get? So the depreciation is, so the depreciation per year. So remember, this is per year. So every year. Working two is capital allowance. The relief that the government gives, capital allowance. Now in capital allowance, there is the first year. The capital allowance in the first year, you have been told it is 50%. 50% times 40,000. That is the allowance that the government gives you. Of course, it is that. So that gives you, is equals to 50% times 40,000. So that gives you 20,000. That is first year. In the second to what? To fifth year, in the second to fifth year is equals to 12.5%, times 40,000. Whatever amount you get. So it gives you 12.5% times 40,000. Now that gives you 5,000. So let's go to our table. The table that, so this is using what? This is called actually liability method. Liability method. I don't need to show you the previous method. So in the liability method, what we need to show here is, I've said, you show the period. What did we say? Those who can remember? Period. You show the carrying amount. That is why we were defining terms. Carrying amount. Next, you show, after carrying amount, you show the tax base. Next, you show the difference. And then you show the deferred tax. Just give me just 2 minutes. I know I'll slightly extend. It is not easy to leave a question halfway. So the year of acquisition of the asset is called year zero. And it was, how will I write this? So we have year zero. So this is year zero. Next year, 1, year 2, year 3, year 4, and year 5. So those are our periods. Okay. So those are our years, or maybe let me just bring them. Okay, so those are our years. So the carrying amount, what did we say carrying amount is? Is the cost of the asset. In year zero, you pick the asset at cost. That is 40,000. The tax base in year zero is also 40,000 because you have not started depreciating and accounting for. The difference is 40,000 minus that. The deferred tax is equals to 30%. The tax rate was 30%. 30% times the difference. So what does it give you? 0. Year 1. At the end of year 1, please understand me. What is carrying amount? Cost of the asset. The cost of the asset was 40,000. 40,000 minus the depreciation at the end of year 1 is 8,000. You can see that. It gives you 32. Now, the tax base is the cost of the asset minus the capital allowance in year 1 is 20,000. The difference is equals to 32 minus 20. The difference is 12,000. The deferred tax will be equals to that amount times, of course, what? 30% or 30%, 3,600. That is the deferred tax. Whether it's an asset or liability, I'll come to it next time. Carrying amount in year 2. Carrying amount in year 2 is, of course, carrying amount in year 1 minus again depreciation for the year, or cost of the asset minus accumulated depreciation. Depreciation in year 1. Okay, I think that is better so that we don't confuse. So that minus year 1 depreciation minus year 2 depreciation. It gives you 24. The next one, year 3, carrying amount is cost of the asset minus depreciation year 1 minus depreciation year 2 minus depreciation year 3. It gives you 16. Like that. Year 4 is again cost of the asset minus depreciation year 1 minus depreciation year 2 minus depreciation year 3 minus depreciation year 4. Finally, carrying amount in year 5 is the cost of the asset minus depreciation year 1 minus depreciation year 2 minus depreciation year 3 minus depreciation year 4 minus depreciation year 5. It gives you 0. Remember, what is carrying amount? Carrying amount is equals to, we said, cost minus accumulated depreciation. So don't forget about that. Tax base is equals to, so tax base we have said is equals to cost minus capital allowance. Minus capital allowance. Don't also forget about that. I'm almost there. Now, again here, tax base will be equals to cost of the asset minus capital allowance in year 1 minus capital allowance in year 2. Is that 15,000. Tax base in year 3 is cost of the asset minus capital allowance in year 1 minus capital allowance in year 2 minus capital allowance in year 3. Next, tax base is equals to cost of the asset minus capital allowance in year 1 minus capital allowance in year 2 minus capital allowance in year 3 minus capital allowance in year 4. It gives you 5,000. And lastly, here, it gives you cost of the asset minus capital allowance in year 1 minus capital allowance in year 2 minus capital allowance in year 3 minus capital allowance in year 4 minus capital allowance in year 5 is 0. What am I trying to say? The deferred tax is only temporary. Okay, let me just get, instead of doing that, let me just scroll so that you can see. So that this is, I just scroll this so that I automatically, so that I save time. How do you get 2,700? It is 9,000 times 30%. Now, please understand me. You can see in year 0 before we started, deferred tax was 0. In the last year, deferred tax is 0. Year 1, there is an increment from 0 to 3,600. In year 2, there is a decrease from 3,600 to 2,000 like that. What does that mean? Deferred tax is only temporary. It is only for a period of time. So next time when we meet, I'll still take time. I'll go back to the same example. But before we meet next time for this standard, what I'm pleading with you, read on what we have covered. That is next Wednesday. I'm not talking of the weekend classes. Weekend classes as usual. Weekend classes as usual. So these, now out of this amount, I'll show you now what goes to the income statement and what goes to the balance sheet. That will be my objective. I'll also show you what is the deferred tax asset and what is the deferred tax liability. So, but for now, you can see here there is an increment from 0 to 3,600. From year 1 to year 2, there is a decrease. Year 2 to year 3, there is a decrease. So here we can say there is an increase. The rest, it is a decrease. It is decreasing in the rest of the periods. But in case, so I'll tell you what to do when there is an increase in tax from year 0 to year 1. It is an increase. What do we do? It increases the tax. You calculate the current tax. I'm repeating. You calculate the current tax and then you add this to it if it is an increase. If it is a decrease, you calculate the current tax and then you do what? You less that, the difference between this and that. Let me answer that in the next. So next time when we come, we will continue with this. When we finish it for 1 hour, the next 1 hour, we will cover financial instruments. So we will finish on deferred tax and then we go to financial instruments. Financial instruments is IFRS 9, IFRS 7, IAS 32, IAS 39. We will cover all those. They are called financial instruments. Thank you so much. Have a good night. See you on Saturday for Kigali students. Kigali students, Saturday keep time. Is it Saturday at 8? If I'm not wrong. Saturday at 8. Saturday when we meet, when we meet on Saturday, we will cover statement of cash flow, which is also very common in exams. So the whole of Saturday will be covering cash flow statements. Have a good night. Silas, why sorry? So on Saturday for Kigali students, we will cover statement of cash flow. Please be there. And then next week on Wednesday when we meet, we will continue with this. Please remember before I forget, email me your cut. Your cut to, again, I said, you email to Charles Omanyo at yahoo.com. Please don't use my official email. You know, you are very many, I don't want the assignments to be in the official email. So please email me your cut 1 into that. Where is the cut 1? It means you are not there in the last 2 classes. Find out from your friends, cut 1, where there is cut 1. Keza, find out from your friends in the group. Good night all. See you next time. I've already typed my Yahoo email. It's charlesomanyo@yahoo.com. charlesomanyo@yahoo.com. You can ask other questions in the WhatsApp group.